Hello, ladies and gentlemen. My name is Marvin Kane. I'm with Kane Impact Financial with my wife, Cavette Kane. We actually have that business we do together. And we've been fortunate enough to be partners with a great gentleman by the name of Douglas Aza with Largo Financial. He shares some pretty financial things with us, and we just want to take a moment to share a concept with you. Many of you may be familiar with called the Rule of 72. But we're going to extend it with some greater thinking to really show you how it works. And if you understand this basic concept about money, you'll start doing things a lot more differently. For example, let's say you have $10,000. The question I would ask you first is, where is it? Most people would say, it's in the bank. And if your money's in the bank, evidently it's earning interest, but not that much. You and I know the interest rates are probably somewhere around like less than 1%. But for the sake of this scenario, we're going to, let's say, it's a 2% interest rate. So this is how the Rule of 72 works. It answers the question, how long will it take this $10,000 based on this interest rate to double? So we take 72 and we divide it by the 2%. That's going to take us 36 years. Now, if you are a 40-year-old person, that means by the time you take that 36 and add it to 40, by the time you're 76 years old, you'll have $20,000. Now, for some of you looking at this for the first time, that's not really a great story. But what's even more amazing than that is what the banks are doing with your money. So the banks, they actually are putting your money into a different kind of account, an account that allows them to earn bigger interest rates. So let's say the bank has a modest interest rate of 12%, and I say modest because it could very well be a little higher and slightly lower. So we're just going to stick around the middle and say 12%. The Rule of 72 applies to the banks just like it does to you. So at a 12% interest rate, and we're still talking about $10,000, divided by 70 into 72, that's going to go in there 6 times. 12 will go into 72 6 times. So that means every 6 years, this $10,000 that the banks had invested is now doubling. So if you're age 40, remember, you have $10,000. When you are 46, the bank would have doubled that same $10,000, and now they have $20,000. But let's extend this out by 36 years and see what would the banks really have made if you set your money in there for 36 years so it could double and become $20,000. Let's see what would happen. So we'll go 56, we add 6 more years to that, that's going to be 52. Then 58, then 64, then 70, and then 76. So remember, the money doubles every 6 years at 12%. So that means at the age of 52, the bank would have earned on your money $40,000, but then it doubles again. Age 58, 80,000. Age 64, 160,000. Age 70, 320,000. Age 76, $640,000. That's what the banks would have earned from that $10,000, and then they're going to send you a check for $10,000 and say thank you. Now, why are we sharing this with you? Because here's what we know. That if you took 100 people by the age of 65, here's what statistics tells us. It says that 50% of the people are going to be borrowing from their friends and family members. The other 17%, they working. Not towards retirement though. They don't have any choice. And then you've got 25%, they're either dead or they are dead broke. Now my question to you is, where do you see yourself in this scenario? Out of 100 people, this is what happens to 92% of the population. Now, there's still 8% left. That 8%, that's for the people who have incomes over $100,000 a year. Ladies and gentlemen, we're sharing this information to you because this is about passing on generational wealth. If you understand these basic concepts, then you'll stop passing on generational poverty. So if you want to know more, just get back in touch with us. My name is Marvin Kane. It's been my pleasure. My wife says hello, and we look forward to talking to you real soon.